Michael Hartnett, one of Bank of America's top analysts, has predicted that emerging markets are the next bull market, which will also benefit from the weak dollar and the recovery of China's economy. In this video, we'll review the reasons behind Hartnett and other analyst predictions, as well as examine some macroeconomic indicators for these developing economies. Hartnett asserted that nothing will perform better than emerging market stocks, as the dollar continues to weaken, as shown by the DXY index. This is due, among other reasons, to the uncertainty caused by President Trump's proposed tariff increases and the U.S. government's high debt and deficit, which some analysts believe is already at levels that are too high for GDP. According to Hartnett, this weak dollar could benefit emerging markets by attracting inflows of money from investors seeking higher returns. In a previous video, we reviewed how the best-performing stock markets over the year were those of European countries, and we observed that the S&P 500 of the North American stock market wasn't exactly the one with the best returns. And when we review the report of the best-performing stock markets of the year in detail, we see that after the top 6 European stock markets, there are several emerging market stock markets with excellent returns for the year. These include Latin American countries such as Colombia, Mexico, Chile, Brazil, and Peru. But within this group of emerging market countries with excellent performance, there are also Asian and African countries such as South Africa, South Korea, Vietnam, and China, among others. So, in a certain way, Hartnett's hypothesis has already been fulfilled. While the appreciation of stock markets in several countries has been significant this year, it is possible that some stock markets still have room for a significant rebound, especially considering the medium and long-term growth potential. It's important to remember that thanks to ETFs, it's possible to index stock market indices in different countries. By purchasing these ETFs, you achieve a valuation equal to that achieved by the stock markets of those countries. Another reason to believe that emerging markets will perform well is the record levels of deviation between the returns of U.S. stocks versus those of emerging market countries. Since 2010, this difference has been increasing, reaching levels not seen since the 1960s. Already this year, emerging markets have outperformed the global index, with a return of over 10%, the MSCI Emerging Markets Index, about 6 points above the MSCI World Index. Other analysts, such as Franklin Templeton, rate emerging market equities as undervalued and underappreciated. In fact, the iShares MSCI Emerging Markets ex-China Index, with its EMXC ETF, has already appreciated more than 8% this year, outperforming the S&P 500. Templeton's team stated that periods of dollar weakness like the current one typically represent a change in the cycle, where emerging market equities tend to outperform global equities. Other analysts, such as Dan Lefkowitz of Morningstar, show how over the past 15 years, the Morningstar Emerging Markets Index, which includes more than 3,500 stocks primarily from Asia and Latin America, has had poor returns, with only an 83% cumulative return between 2010 and 2024, while the Morningstar U.S. Market Index has nearly sextupled. Part of this divergence is due to a group of U.S. companies, including the Big Seven in the technology sector, which have been extraordinarily profitable and growing rapidly, dominating the global investment landscape for more than a decade. Another indicator of this divergence is seen in the share of U.S. stocks in the Morningstar Global Index, which rose from 40% in 2009 to 64% by the end of 2024. Part of this behavior has been due to the strength of the dollar against other currencies. After bottoming out in 2014, the U.S. currency achieved continuous appreciation for more than 10 years. This strength has made investing in other markets unprofitable. For example, the Morningstar India Index achieved an excellent average annual return of 13% between 2010 and 2024, but when converted to dollars, this return is only 8.3%. Other causes of the underperformance of emerging market stocks have included the collapse in commodity prices, the conflict between Ukraine and Russia, and political unrest in China and Brazil. For example, at the end of 2020, Tencent and Alibaba were already among the world's 10 largest companies, but now many even consider China uninvestable, completely changing the narrative from the early 2000s, which spoke of the dizzying rise of emerging markets. Valuations also potentially reveal opportunities in emerging markets, as emerging markets have been trading at a significant discount to U.S. stocks for several years now. As can be seen in the figure, the price-earnings ratio at the end of the year reached one of the largest divergences, with emerging markets averaging a multiple of 14 times, compared to about 26 times for the U.S. stock market. But this hasn't always been the case. Between 2000 and 2009, the North American market experienced a lost decade, while emerging markets, on the other hand, were one of the most attractive assets. During this period, The so-called commodity supercycle was observed, driven by China's economic growth. But Dan Lefkowitz explains how the discount in emerging market prices and multiples is largely due to their higher risk. However, for Lefkowitz, there are several reasons to believe that emerging markets could continue their recovery. On the one hand, the weakening dollar and the prospect of North American stocks falling short of very high expectations due to slower economic growth. Furthermore, among the reasons for the improved outlook for emerging markets is an increase in economic growth and profits for companies in countries like India and Indonesia. Likewise, the energy transition would benefit these countries, as they massively require raw materials like copper, which are largely produced in emerging countries. Even in a recent Morningstar report on 10-year return forecasts, Brazil, China, and Korea were among the stock markets with the greatest upside potential, with a long-term view. So far, Korea has performed excellently this year, but China and Brazil have not performed badly either. Another reason to consider emerging markets is their lower correlation with U.S. equities and other assets, which means that if the latter performs poorly, emerging stock markets will not necessarily follow suit. On the one hand, basic materials and energy produced in these emerging markets have an increasingly smaller share of the U.S. market, and the Chinese economy, which accounts for 30% of emerging market indices, has a different economic cycle than the United States. Lefkowitz explains how emerging markets have successfully recovered for past downturns. Reviewing some macroeconomic data, we see that emerging markets have quite positive economic growth prospects, with Asian countries expected to average 4.5% growth by 2025 and 4.6% by 2026. This is more than double that of developed Western economies. Noteworthy is the expected growth in India, with potential growth of 6.2% by 2025 and 6.3% by 2026. For all these reasons, analyst Lefkowitz, like Hartnett, suggests that emerging market stocks should have a place in investment portfolios, which is in line with our opinion. Although analysts such as Amy Arnott recommend having a maximum 15% stake in an investment portfolio. In an upcoming video, if you give us a like, we'll be reviewing some emerging markets that may still have a good chance of being interesting, given the high valuations of American and some European stock markets. Remember that in the video description, you'll find the link to the best course to learn technical and fundamental analysis for investing in stocks. There's also a link to the best platform for buying stocks on the stock exchange, regulated in the United States. If you enjoyed the video, give us a like, subscribe to the channel, and share the content.